Well, ladies and gentlemen, welcome to another episode, a sterling episode, I'm going to make bold to predict, of Grant's Interest Rate Observer of the Air. I am Jim Grant, and with me today, as customary, is Phil Grant, editor of Almost Daily Grants, the great Evan Lorenz, the deputy editor of Grants, and at the controls, Eric Whitehead. But this is not just a North American production today. We have telephone, we have Jonathan Tepper, who, as you will presently hear, is an Oxford man. Yeah, he went to Oxford and a Rhodes Scholar to boot, and he is the chairman of Rhodes Scholars in Britain. But more relevantly for this production, he is a financial thinker of great merit, has been thinking in particular about oligopoly, size, and the end, perhaps we'll hear more about the reversion to the mean of corporate profits. But we are not just reaching out to Great Britain. We are also privileged to have with us John Hempton, who is a co-owner and I guess a progenitor of Bronte Capital. John is one of the great short sellers, one of the great thinkers about fraud, not perpetrators, but mind you, thinkers about fraud. And he comes to fraud business, the unmasking business, through very respectable channels, including that of the chief analyst of tax policies in New Zealand. Is there any fraud in tax in New Zealand? I suppose it's a little bit. But John, welcome to you.
Seriously, is there any fraud in tax? Do you think that there's a country without tax cheats?
Well, I'm just asking. There's fraud in imposing taxes, I think we can all agree, but be that as it may. Jonathan Tepper, we would like to start with you. I would like to start with you, and so would Evan Lorenz. Evan is such a thoroughgoing analyst. He has actually prepared a question. So I hope
Fantastic.
I hope you're prepared for this.
Well, thank you so much for having me on the podcast. I am a huge admirer of Grant. Been reading what you've written for years, and I don't know anyone who's sensible who doesn't subscribe to you. So it's a pleasure to finally be able to speak.
Oh, thank you, Jonathan. That's awfully nice to hear. All right, here is the question from Evan. Evan, I'm going to let you read your own question, right? Because you wrote it. Go ahead.
Well, John, your oligopoly report from January was quite eye-opening. The question I have for you is, active managers tend to do best when there's a lot of companies to choose from and a lot of dispersion of returns. Yet you note the number of public companies in the U.S. has halved over the last 20 years. Your report also has an extraordinary conclusion that investing in industries that are not competitive delivers an extra 900 basis return over the market. Passive strategies usually follow market cap-weighted indexes, which are usually overweight the big monopolies and oligopolies you wrote about. What does this mean for returns that active and passive management can earn?
Sure. So the study that I cited was by Gustavo Grullon. That's Grullon. He's a professor at Rice University, and he has done an extremely comprehensive report. You can find it online. It's called "Our Industry is Becoming More Concentrated?" And the reason that I approached the problem was that variant perception builds leading economic indicators and leading liquidity indicators, which are meant to sort of tell us where the economy is going in terms of growth, in terms of inflation, forecasting recessions. And so a lot of very big family offices and hedge funds are clients of Variant. And one of the charts that we show every month in our leading indicator watch is the U.S. wage chart. And so I was very interested in why are wages not going up in line with what some of our leading indicators for wages were saying. So you can look at a wide variety of things, whether it's initial unemployment claims or the NFIB survey of small businesses. And they were basically all saying that wages were going to go up, and that because of that, you would end up seeing the reverse of wages going up is obviously return on equity and corporate profits going down. So there was a bit of a disconnect, and that's when I started diving in and reading an enormous amount of academic research. The piece by Grullon that I read was by far the best, and it was a truly astounding piece of work. He's also done a few other pieces, one specifically on the number of public companies, which you referred to as well, to that chart that we showed, where the number of public companies has halved since 1997. Some of that's due undoubtedly to Sarbanes-Oxley, where it's simply just much more costly to be a public company versus a private one. Some of it may also be due to the fact that Silicon Valley now can fund themselves privately, so there's a lot more unicorns that are not public, and we don't know whether the valuation would be the same in the public as a private market. But even beyond that, if you actually look at the census data for companies, from the U.S. government, it's showing that there's been a essentially decline in startups, there's every year there's an exit rate, meaning that companies that don't do well go bankrupt, or older people retire and close their businesses down. So there's a natural attrition rate going on. But what's worrisome is that the startup level has also declined precipitously. And so what's happening is that you have fewer and fewer bigger companies. And I started approaching this essentially from a top-down perspective, which was, could this be driving the low wages that we're currently seeing, and hence the abnormally high corporate profits? And then, of course, it opens up a host of interesting possibilities from a bottom-up standpoint. If you start considering, well, what does this then mean for industries in terms of industrial concentration?
Hey, Jonathan, this is Jonathan Tepper. This is Jim Grant again. Where does this lead you with respect to picking investments? What names come to mind? What opportunities do you see?
Sure. So some of the monopolies are obvious, and don't require a lot of thinking. Some of them are old. So, you can think of, for example, Comcast, consistently wins the vote for the most hated company in America. And that's because, people don't really have a choice when it comes to their local cable company. If you provide a high bill and a poor level of service, you'll have very annoyed consumers, but they can't go anywhere.
But Jonathan, are these longs or shorts?
Well, this is a funny question. So I'm writing a book right now called The Myth of Capitalism, and it's called The Myth of Capitalism because I think capitalism involves competition. And I think that what we're seeing now, of course, is the absence of competition, and a lot of this is essentially being driven by monopolies. So to answer your question, you could argue that what's bad for workers, what's bad for society, what's bad for consumers in terms of the absence of choice, in a way is good for shareholders because, if you look at monopolies, they tend to have fairly fat profits. And a lot of this, really is because the consumer doesn't have a choice. And so if you go back to the term robber baron itself, it has a medieval origin. There were barons in Europe in the Middle Ages who had roads that went to their lands, and they didn't do anything to keep the roads up and, repair them and keep them in good condition, but they would extract a toll as people went through. And so if you were a baron that didn't maintain your roads but still charged a toll, you were a robber baron because you weren't providing a service for the toll. And so obviously translate that to the 19th century, which is when the term entered the U.S. vocabulary, and then to the 21st today. These are companies essentially that, like Comcast, that you could argue don't really provide you with a great road, and still
are they good? Are they good investments,
power.
Jonathan? I mean, you mentioned the word
yes,
obvious, and some traders are wont to say that if it's obvious, it's obviously wrong, which is to be sure glib and not always profitable. But the obvious or self-evident monopolies and oligopolies you have identified, are they buys? Are they sells? Are they? Or should we be looking elsewhere?
Yeah, I would argue that in general they would be buys.
Would be.
Part of this is that
I'll give my opinion.
Yes, I want to hear from New Zealand about this. I think Britain has spoken very, very well, Jonathan Tepper.
No. My simple observation here is that there are some areas where governments are allowing mergers that would never have been allowed in. Things like the seed business, which is consolidating out of sight with Dow merging with DuPont, Bayer buying Monsanto. That's probably going to be considerably more profit future because of it. Comcast has been a monopoly forever, and that's why it behaves so badly. It behaves so badly because it can. And your question as an investor is going to be, is this a stronger monopoly than it was 10 years ago or 5 years ago?
Yeah.
I got my opinions on that. I'll leave those to other people to decide. But, as a general rule, it seems there are more ways around Comcast than there were.
Jonathan and John, it's a very interesting thing to think about concentration in this day and age. On the one hand, we read daily, or indeed are bombarded almost hourly with the assertion that we live in a time of disruption and vulnerable legacy business models, on one hand. On the other hand, we hear, and Jonathan Tepper, you have expressed it very well in this Variant Perception Oligopoly USA report, the title of that being Oligopoly USA, you expressed it very well, that in fact, the barriers to entry are rising and that the oligopolies in pace are becoming more disreputable and less disruptible. So which is it? Are business models shakier or are they sturdier?
So in theory, these business models should be disrupted and should be shakier. But one of the interesting things is that the increase in industrial concentration has had a few sources. One of those, obviously, mergers. So as John pointed out, mergers that would not have happened 40 years ago have been allowed. And this really came about with the Reagan merger guidelines in 1982. And it's unsurprising that, you've written very well in Grants about the conglomerate merger wave in the 1960s. And those were very strange, where you'd end up with a movie studio owning some oil assets and also some ball bearing companies. And these are just like crazy collections of assets. But the reason they did that was that they couldn't actually buy competitors. And so antitrust was enforced. So if you wanted to buy, you had to go further afield and outside of your industry. But in 1982, what happened was the Chicago School took over, and they decided that you could buy competitors, and that bigger was beautiful, and that as long as the consumer was promised a cheaper price, that the consumer welfare was enhanced. And so it's unsurprising that since 1982, in every single decade since, we've had a merger wave, whereas merger waves, in fact, were quite rare before 1982. And so, if you think of the NCAA sort of brackets, right, you start with quite a lot of competitors, and every decade it then means you're getting, fewer and fewer players, until you get down to like the Final Four, the Final Two. And that's pretty much what's been happening in markets. On the other hand, but rather another factor that's contributed to this is, and you also write about this in Grants, is the increase in regulation. And so as the regulatory state gets bigger, and as the number of laws on the Federal Register and in state law books gets bigger, it becomes much more costly for a small company to come in and disrupt and compete. And so you can almost map essentially the increase in concentration tied to the increase in regulation. And
well, this too will pass, and all these merger waves, and there were many, of course, before 1982. I have on my bookshelf a 6-part collection by an author, I think his name is Dewing, D-E-W-I-N-G. That's D as in David, and he wrote about the merger wave of the turn of the 20th century, railroads and other industrial consolidations. And he pointed out, as many have concerning subsequent waves of consolidation, that the economics actually did not work very well, and that what was not meant to be consolidated finally flew apart again. But hey, John Hempton, I on behalf of our almost myriad listeners, I want to ask you, as someone who knows a thing or two about selling short and did such great work, for example, only one example on Valiant, the former Valiant, what are you seeing in the way of short sale candidates? And is the incidence of corporate fraud, in your opinion, waxing or waning?
Small cap fraud is unbelievably rife, particularly in America. There's a couple of reasons for that, one of which is the cost of, say, having a $500 million company has just gone through the roof. Even if you don't think the Starbucks cost is the real cost, every time you miss earnings, you get an ambulance chasing lawyer. On the flip side, you have private equity who is willing to buy for very high prices anything that is a plausible $500 million company. The result of which is that the whole bottom end of the US stock market has been denuded of things that actually have real prospects. Because if you had real prospects, the easiest way of monetizing them is to sell them to private equity and as management take a 10% kicker. On the flip side, we've had a bull market that's gone for a very, very long time. And in bull markets, you can sell crap to people and people will buy and people will manufacture crap to be sold. So there's a quite absurd amount of small cap fraud. In fact, if you sort of threw a dart at a list of companies with them at the bottom end of the Russell, it's probable that you'd hit a fraud. I mean, the Russell has become this sort of absurd index full of stocks run by people that I wouldn't want to have marry my daughter. Large cap fraud is around, and there are some pretty good examples, and I don't really want to say them aloud.
John, just give us don't mention the names, just the tickers, if you would, please.
Yeah, okay, right. But what I think has happened is that the large cap frauds always had a skepticism about their accounts. And so you'd see these things where the market PE was, and I'm showing my age, 16 here, and the ones that were suspect had a PE of 12, and every now and again they disappear. And now the large cap frauds have a PE above the market because they produce above market growth rates. And, it's easy enough to produce above market growth rates if you're making the numbers up. Yeah. And skepticism has disappeared. I mean, there's also a large amount of just excessive optimism where we have managers who are the maddest people, who believe their own bullshit, who think that the rising tide of the last 5 years proves that they're a genius, have been buying. And, this is part of the merger wave, that the maddest people have had the best access to finance and have bought everybody else. And it might work for some of them, and it might work for some of them simply because the competition's disappeared. I mean, I come from Australia, which is the extreme version of what Jonathan Tepper says. We've got two four banks, and they're the most profitable banks in the world. We've got two retailers. They're both very badly run, and they're the most profitable grocery retailers in the world. Australia is the land of fat margin oligopolies. And, these merger waves might actually work out in some instances, but in some instances they're going to come apart, and we're seeing a few of those, and those are being masked by bad accounts.
John, would you decipher a recent tweet by somebody who signed his name John Hempton? And the tweet reads as follows.
Yeah, okay.
That moment when you realize the stock you have owned for a few years and on which you have doubled your money was done on entirely, bullshit. That's right. We're saying that word twice now.
Yeah, look.
Bullshit, now 3 times.
Yes.
Analysis.
Yeah, look.
Come on.
I can't tell you the name of the stock.
Evan, tell us the name.
We're still selling it, right? We're still selling it, and we'll be selling it for a while because it's a very big position. But any decent intellectual analysis will show that some of the money that you've made in this bull market was made not because you were smart, but because it was a bull market.
Well, that's not the first time.
I go through my portfolio, and sometimes I ask myself, was I smart or lucky? And in this case, I was lucky, and I was lucky with bells and whistles on. We're up 115% on a stock that we really should not have invested in, and in which pretty well every paragraph of my original note on it, my internal note on it, turned out to be wrong. I suspect that that's true of a lot of stocks. I, in this case, feel like I had the honesty to admit it to myself.
You don't have to give the money back, John. You can still keep the money.
Oh, no. Look, if I had to give the money back, then could you tell me I was short ABN AMRO?
No, it doesn't work that way.
When it was bought for $100 billion.
Sorry,
I was
it doesn't work. No.
Short Charter One Financial.
Nope, doesn't work.
When it was bought and it went bust.
Yeah.
And in those cases, I got intellectual satisfaction because the purchaser lost all their money, but I would swap intellectual satisfaction for a refund.
Well, John, you know that intellectual satisfaction is untaxed.
My clients won't see it that way.
Well, I want to thank 2 fabulous guests from across the seas. Jonathan Tepper, who was the author of a really important new study on oligopoly, and John Hempton, who buys low and sells high, and then sells high and buys low, ambidextrously and profitably.
And I want to say
and
one
tweets.
thing. Because I wasn't here to say it. I've been a subscriber to Jonathan Tepper's research for ages. And I'm a dyed-in-the-wool micro, look at the facts on the ground guy. And Jonathan Tepper's a dyed-in-the-wool macro, look at it from the top guy. And sometimes we align. And when we align, every time we've aligned, we've made money. Lots. When we haven't aligned, I've just let him do his own.
Well, no more suspense. Are you aligned at the moment, and on which ideas are you aligned?
We don't have actually a strong version at the moment. In the past, we aligned totally on biotech, where he was looking at red flags from the top down, and I was looking at absolute criminal scumbags lying about science. We aligned before that on shale, and I'll let you know, Nick.
Okay.
In fact, we'll even talk about it. We'll be back.
Okay. Well, the promise to be back is most heartening. John and Jonathan, thank you on behalf of the listeners to Grants. I know they are as delighted as we are. So until next time, ladies and gentlemen, thank you for listening. This is Jim Grant on behalf of, Grant's Interest Rate Observer. I think it's the name of the institution.
Thank you so much.
Okay.